Everything seems expensive. Bitcoin is high, the stocks are high, gold is at all-time highs, and at the same time it feels really bad to hold cash because the inflation rate is high as well. What can we do in this situation? What asset class is still cheap? And will it make sense to buy this cheap asset class? Is it likely that it's going up? Let's have a look at the macro environment. Now what we see over here in this chart is the aggregated inflation rate in the US in the last 3 years. And during the COVID stimulus checks and the deglobalization, of course, prices shot up a lot. Then they somewhat peaked in September of last year, took a dip, now going back up again. But overall, of course, times are still tough. Prices are still high. And it might not appear that way when we just look at the inflation rates, because the inflation rate simply compares the price to the last year. But when we stay at a high level, then even an unofficial inflation rate of 2.05% is not nice. Officially, we are even at 3.2%. So what we're seeing here is actually the truflation, not the officially reported inflation rate. So this is an inflation rate that measures the CPI constituents way faster, way more accurate. And we can see that food delivery, for example, has an inflation rate of 5%, whereas food at home is relatively cheap. Household items aren't getting that expensive, but housing, as in rent, etc., still continues to get more and more expensive. So here are the official inflation rates. They are slightly higher, but they're still pretty far away from the 2% target. And that's the justification by the Federal Reserve why the target interest rates are not coming down. So this is why everybody is saying we don't see new all-time highs in stocks, etc., right? It's the higher interest rates, or in other words, the lack of monetary expansion. This is USM2, no net increase since September of 2021. And so since September of 2021, the Nasdaq also didn't rise that much. Since September of 2021, the Nasdaq relative to the S&P 500 didn't outperform anymore. So have a look at this. This is the S&P 500 divided by USM2. This is a very long-term chart starting in 1956. And pretty much all of the gains in the stock market are simply due to the monetary base expanding. So when you feel like you're getting more money by investing in stocks, that's actually not true. When you measure this just in the monetary base, then you're not getting more purchasing power. The official inflation rates are understating how much purchasing power we actually lose. The monetary base is expanding by roughly 6.5% per annum long term. Not recently, of course, not in the last 2 years, but over the long term, 6.5% is the value. If your income and your wealth isn't growing by at least that number every year, then you're falling behind. Now here's the big question mark. All the prices are up. Property is up, stocks are up, crypto is up. What can we do in this scenario when inflation still is relatively high and interest rates are high? How can we still get ahead? Where is the opportunity? The big question is, where will the interest rate go? Will the interest rate go down again or will it go further up? Some people are saying that interest rates might rise even further. I do not think so. Again, because the target interest rates are above 5%. The real consumer prices are growing by 2%, officially by 3.2%, but still both of those numbers are lower compared to the interest rates. So I do not believe that we'll see further rising interest rates unless we see a sudden spike in inflation rates again, but I do not expect that. Where should that inflation come from? And so I believe the most likely scenario is that at some point prices will come down somewhere. This might be the commercial property market, this might be the stock market, this might be the financial sector. I don't know what will go down, but at some point something will implode. Probably. Those high interest rates are not sustainable for any market, right? That's why we don't see any movements in the property market, for example, right? That's why nobody wants to sell their current house. They have got low financing costs. They don't want to move into a bigger house with bigger financing costs, so they simply hold on to the inventory, artificially keeping those property prices up. So those prices are not sustainable. But will it be the property sector that goes down first or something else? I don't know, but I think at some point something will break and then of course interest rates have to go down. And so how can we benefit from dropping interest rates? It's easy. It's by buying long-term government bonds. Government bonds with a very long duration that have a lot of sensitivity to interest rate changes. When interest rates go up, then government bonds go down. When interest rates go down, then government bonds go up. There's an inverse direct relationship because the value of a government bond is determined by the present value of all the future cash flows. And the higher the interest rate is, the more you have to discount those future cash flows. The lower the interest rate is, the more those future cash flows are worth to you, the less you have to discount them. So interest rates going down means values of bonds going up. So this is how we can take advantage of this. Those high interest rates, in my opinion, will come down for some reason at some point in the future. And the way to make money with this is to buy something like SPTL. This is an ETF on long-term government bonds. And have a look at how they got crushed. They went down from top to bottom by 50%. That drop started in July of 2020. And that was over here. This is when the market already anticipated that at some point the rates will go down. So there was quite a bit of a foresight here, right? More than 1 year until the rates actually went up. So far, the market is not pricing in interest rate cuts. From the bottom to the price today, we only went up by 7% in those long-term bonds. And so yes, we might stay at this level maybe for another year. Who knows? But that doesn't mean that those bonds can't recover earlier. They react faster. And so this is where I believe is the diversification opportunity. If you currently hold a lot of property, if you hold a lot of crypto, if you hold a lot of stocks and you don't want to hold cash and you want to benefit from a potential future crisis, at least you want to hedge yourself against this, then buying something like SPTL, I believe, is a very good idea. I personally also buy those kinds of ETFs now. I don't want to lose all the gains I made in crypto and in the stock market just because some random new COVID is coming out. I want to be able to take advantage of dropping prices. And of course, if currently your wealth relative to your income isn't yet that large, it's not necessarily a problem when prices drop, because then you can simply buy with your income. But if your wealth is already relatively large relative to your income, then you need to have some money that is not impacted negatively by a declining economy. You need to be able to take advantage of a possible liquidity crunch that probably at some point will come. I don't know if it comes tomorrow or in 2 years, but probably at some point it will come. And it does make sense to be prepared accordingly. And I believe long-term government bonds have a very nice potential upside, of course, in case interest rates go down again, which I believe will happen. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. There's also a free Telegram. Link is down below.